Have you ever felt like you're caught in, well, a financial trap? Like you're constantly chasing a moving target for what middle class even means today. You look at your bank account, you look at your expenses, and then, you see something online, and suddenly what you thought was enough, it just isn't. It feels like the goalposts just keep shifting.
Yeah, you're definitely not alone in feeling that way. It's a very common sentiment right now.
Well, today we're taking a deep dive into this fascinating, sometimes, let's be honest, frustrating world of personal finance and investing. And our guide on this journey is going to be the insights from Radhika Gupta. She's the MD and CEO of Edelweiss AMC, an entrepreneur and author of Mango Millionaire. Hmm. We're drawing directly from a recent conversation with her and also a related study guide just to pull out the most impactful bits for you.
Exactly. And our mission today, it's pretty clear. We want to unpack how these money conversations are changing so fast, especially in India.
Hmm.
We'll challenge some, common ideas, give you some actionable frameworks for smarter saving, smarter investing, and hopefully help you cut through all the noise, the information overload, and really break free from those financial traps you might not even realize you're in. Radhika herself says money should be deep, fun, and approachable, not scary or full of jargon.
Right, none of that fear-mongering.
Exactly. And that's the spirit we want to bring today.
Okay, so let's jump right in. We have to start with something that went, well, absolutely viral recently. This LinkedIn post claiming a 70 lakh rupees annual salary is the new middle class in India. I mean, when you first heard that number, did it sound familiar, surprising? What was your reaction?
It's fascinating because Radhika Gupta had a very direct, almost playful pushback on that. She pointed out that the technical definition of middle class income in India is actually much, much lower, closer to 6 to 8 lakh rupees a year. She even sort of jokes that by that definition, none of us are middle class, but we all still love calling ourselves that.
Why is that? Why do we cling to that label?
She calls it middle class psychosis. It's this deeply ingrained value system from how many of us were raised. It makes us feel like it's almost a badge of honor to stay in that bracket, financially speaking, even if our income has gone way past it.
That middle class psychosis idea really hits home for a lot of people, I think. It's like a cultural identity thing. But okay, beyond the psychology, that LinkedIn post did mention some real tangible factors driving this feeling that 70 lakhs is just, average now. What were they?
Yeah, absolutely. It wasn't just plucked out of thin air. The post highlighted three key things. First, rising taxes in India. That obviously eats into your take-home pay. Second, something we all feel, is the increasing cost of living. Everything just costs more. And third, and this is where Radhika says things get really wild, is the huge influence of social media, that constant comparison culture.
Ah, the comparison culture. That part really stood out. It's not just keeping up with your neighbors anymore, is it? Radhika shared this story about a Gen Z kid.
Oh, yeah, that was something.
He felt he couldn't work more than, say, 45, 50 hours a week. And why? Because he needed time for the gym, for vacations.
Just to compete on social media.
Exactly. To keep up appearances online. It's a totally different kind of pressure. She said it's driving young people to do crazy things.
And crazy things isn't an exaggeration. I mean, you almost feel a bit relieved social media wasn't quite this intense when we were younger, right? Because the consequences are serious. We're hearing these stories, real stories, of huge losses in F&O trading futures and options, like an uncle losing 15 lakhs in a month. Wow. Or a young professional, mid-30s, losing 90 lakhs. 90. All because he saw a friend post a picture of a fancy car online and felt he needed one too. This isn't just, feeling a bit envious. This drive for aspirational spending, constantly fueled by what you see online, it can lead to real financial ruin.
It really shows how those external pressures can just completely hijack sensible financial decisions. These aren't just odd stories. They show a bigger trend. So for you listening, what stands out here? Have you felt that pressure? Seen it around you?
It's a good question to pause on.
Okay, moving from comparison culture to maybe financial commitments, let's talk EMIs, equated monthly installments, because the data here is, frankly, alarming. The average percentage of income going towards EMIs in India jumped from 46% back in 2020, around the pandemic start, to 61% in 2024. That is a massive leap in just 4 years. It suggests a really fundamental shift in how we're handling money.
Yeah, it's a huge number, but honestly not that surprising when you look at how credit access has just exploded in India. It's everywhere now. Think about these stats Radhika mentioned. 7 out of 10 iPhones are bought on loans.
7 out of 10.
1 out of every 3 weddings, funded by loans. 25% of white goods fridges, washing machines loans again. She even made the point about airport lounges being packed. Why? because everybody has 2, 3 credit cards. We've gone from a country that traditionally shied away from debt to maybe swinging too far the other way, embracing it like never before.
So with credit being so easy to get and EMIs becoming such a big part of life, it forces the question, is all debt bad? We kind of know the answer isn't simple, but Rebecca makes a really important distinction between good debt and bad debt, and it feels particularly relevant now.
Absolutely crucial distinction. Good debt, in her view, is basically a tool. It's debt that helps you build something productive in asset or boosts your future earning potential. She mentioned taking an education loan herself. That's good debt. It built her skills, her career. A home loan, especially with current rates around 7.5% to 8.5%, is another classic example. You're building equity in an asset. Even, say, financing a laptop you need for work. That enables you to earn. The key is using it strategically, where the EMI isn't a constant stress, but a planned part of your finances.
Right, it's an investment in your future, essentially.
Yeah.
So on the flip side, what's bad debt?
Bad debt is pretty much what you'd expect. It's borrowing for things that don't increase in value or generate income, your wants, not your needs. Think using a loan for, I don't know, fancy jewelry that depreciates, or financing tickets to that Coldplay concert you mentioned. Those are just expenses. They don't build anything for your future.
Got it. Pure consumption spending on credit.
Precisely. And this leads to a really worrying trend she's seeing. People are genuinely getting caught in debt traps. She shared that she actually gets private messages during Zoom calls.
Really? During calls?
Yeah, from people, often young people, reaching out, saying they're overwhelmed, asking for help. I mean, messaging a stranger for a financial lifeline, that's a huge warning sign that things have gone wrong.
That's quite sobering. So it really makes you think, for you listening, how does your own debt look? Is it mostly building assets? Or is it just fueling wants?
A really vital question for everyone to ask themselves, honestly.
Okay, let's challenge some conventional wisdom now. Savings rules. Many of us have probably heard of the classic Western rule, 50-30-20, 50% needs, 30% wants, 20% savings. But does that rule actually work for you living in India with our specific context?
Well, Ratika Gupta argues pretty strongly that it's problematic for India, and her reasoning makes a lot of sense. The main issue. We don't have the same kind of robust social security system or public infrastructure as, say, the US. Things like reliable public schooling or affordable public health care are just not as widespread here, meaning individuals bear more of that financial burden. So if you're only managing to save 20% of your income, by the time you hit your 40s or 50s, she warns you're basically heading for a retirement crisis.
A retirement crisis. That's a stark warning.
It is. Our reality, our family responsibilities, our future needs, they just demand a different approach than that simple 20% rule.
Okay, so the 20% rule might fall short, but you could argue maybe 20% is better than nothing, or that setting super high savings goals early on might just demotivate young earners. You know, that YOLO mentality you mentioned. How does her alternative approach tackle that?
That's exactly what her age-based framework is designed for. It's tailored to the Indian reality and different life stages. She suggests starting differently. In your 20s, aim for maybe 10% savings. The goal then isn't massive wealth accumulation. It's about building a habit, right? Getting started, even amidst those YOLO, you only live once vibes where experiences often feel more important. Then as you get into your 30s, that's when you ramp it up, significantly aim for 30%. Why? Because that's usually when the big stuff hits. EMIs, home, family, maybe supporting parents. Those financial responsibilities become very real. And then crucially, by your 40s, she says you need to be saving 50%, half your income.
50%, that sounds intense.
It does, but she frames it as essential, not optional, to avoid that future crisis. You have fewer earning years left, potentially higher responsibilities. It's about building a solid foundation for the long haul, not just hitting an arbitrary number.
That framework feels much more connected to real life stages, doesn't it? Adapting as you go. Now, shifting slightly, but still related to managing money effectively, Rebecca also talked a lot about couples and finances. She really stressed open conversations, using automation, making it possible to be, and she put it, independent yet collaborative, which is key, given how often money causes friction.
Oh, absolutely. It's such a common source of stress in relationships. Her approach sounds very pragmatic. Having those transparent chats and setting up systems can really help navigate shared goals while keeping some individual control.
And their personal setup sounds really practical. They have their own individual accounts for personal stuff, but then a joint account for the shared household things like the home loan payment, their son's school fees. Both contribute to that. But here's what she called their secret weapon: individual investment policy statements. An IPS.
An IPS. Tell me more.
Yeah, think of it like your personal financial rule book. A written document outlining your specific goals, your risk tolerance, what kind of assets you prefer, your whole investment philosophy. She says it's not just bureaucracy, it's their anchor point. It stops them getting swayed by FOMO, fear of missing out.
Oh, okay. So it keeps them grounded in their own plan.
Exactly. Even when everyone else is chasing some hot stock tip, they also do quarterly financial check-ins and a big annual family sit-down.
Mm-hmm.
In that meeting, they budget, look at income, plan expenses, and specifically decide on one or two fun discretionary things to spend on just for enjoyment.
That's a really structured, thoughtful way to do it. Balances discipline with enjoying life. It definitely makes you think. Have you had those open money talks with your partner? Have you maybe created your own financial anchor points to keep you focused?
Good questions. Now, let's get into investing itself, specifically SIP's systematic investment plans. Because there's a common worry right now, isn't there? When the market's down, or just flat for months, people start doubting their SIPs. They ask, why aren't I seeing profits immediately? Is this even working? Radhika must hear this all the time.
All the time. And she says it shows a basic misunderstanding of what SIPs are for. They are not instant gratification tools. That's the key. Their real power is that they make you buy regularly no matter what the market's doing. Actually, SIPs work best when the market is down because your fixed amount buys more units when prices are cheaper. It's automatic averaging down. Plus, they enforce discipline. They stop you from making emotional decisions, trying to time the market, which, let's face it, almost never works out well.
Right, takes the emotion out. And to back that up, she shared a really powerful stat from their own fund data. For their oldest mid-cap fund, the minimum worst-case 10-year SIP return was 9%. Think about that. The absolute worst outcome over a decade still gave 9% returns annually.
That's pretty compelling.
And the disciplined investors, the ones who just stuck with it, they earned 18, 19% over that same period. It really highlights the long-term power.
Absolutely. It's about time in the market, not timing the market, especially with SIPs. So, okay, if you're convinced on SIPs or mutual funds long-term, how do you choose them? It feels complex, like you need to be a stock picker. Radhika offered some clear guidelines here. First, cut the noise. Focus on the main understandable fund categories, things like flexi-cap, large and mid-cap, multi-cap, mid-cap, small-cap, basic debt funds, maybe some international exposure. Don't get lost in niche products initially.
Keep it simple. Focus on the core. Makes sense.
Second, you need to trust the AMC, the asset management company. That means looking at the people running it, their track record, their actions, not just glossy marketing. Third, and this is crucial, analyze the portfolio. Actually look at the fund's fact sheet. Are they holding, say, 50, 70 stocks? That's diversified. Or just 20, 30? That's more concentrated. Does a fund called mid-cap actually hold large-cap stocks? Is it tilted towards value or growth? You need to check if what they say they're doing matches what's actually in the fund.
So do your homework on the specifics. And what about performance? Everyone wants good returns. What's the key metric there?
This was interesting. She said the single most important metric for judging consistent performance is the 5-year rolling return. It's not just looking at one arbitrary 5-year period. It averages the returns over every possible 5-year window within the fund's history. This gives you a much better sense of consistency and what a typical investor actually experienced, regardless of when they started investing. It smooths out the luck factor.
Okay, rolling returns, not just point to point. And what about rebalancing? How often should you tweak things?
Her advice was, don't rush it. Definitely don't rebalance before 3 years have passed, usually more like 5 years. Doing it too often can trigger taxes, and you might make short-sighted moves that hurt your long-term returns. Let the strategy play out.
Good discipline points. Now, besides those standard mutual funds, she also touched on a couple of other interesting vehicles. Smart beta funds. What are those about?
Yeah, smart beta. They're kind of cool. They're rule-based funds designed to give you exposure to specific investment styles or factors like momentum or value. Active managers might not always use these pure styles, so smart beta funds can complement your core holdings, adding a different kind of market exposure, often at a lower cost.
Interesting. And hybrid funds.
Hybrid funds basically mix different asset classes. Some blend equity and debt, maybe even gold. Those are often called multi-asset funds. Others might have a limited amount of equity combined with fixed income, like equity savings funds. These are great for specific needs. She gave the example of her own retired mother-in-law. She uses an equity savings fund because it offers some growth potential, but is conservative enough for her to take regular quarterly withdrawals for income. Perfect fit for her situation.
Tailored solutions. And the big question people always ask,
Mm,
how many funds should you actually own?
right. Her answer was practical. Aim for around 8 to 12 funds, max. But the key is diversification by style and category, not just owning a huge number of funds. She warned against having like 100 different schemes with tiny SIPs in each. That just becomes over-diversified, messy, and hard to track. It defeats the purpose.
Quality over quantity. Makes
Yep.
sense. And looking forward, she mentioned something new, specialized investment funds, or EFIS.
Yes, SIFOs. She seemed quite excited about these. They're a relatively new category. Think of them as bridging the gap between regular mutual funds and the high-end stuff like PMS, portfolio management services, or AIFs, alternative investment funds, that usually require huge investments. SIFs have a much lower entry point, maybe around 10 lakhs, but they offer more flexibility in strategy like PMSAFs, combined with the simpler, more favorable taxation of mutual funds. She sees them as a way for more investors to access sophisticated strategies, likely drawing money from the PMSAIF space rather than taking away from core mutual funds.
Interesting evolution there. Okay, we've covered a lot of strategy, but sometimes the best lessons come from, well, mistakes or things you avoid. What asset classes does Radhika Gupta personally just steer clear of?
She was very clear on two. First, real estate, beyond her own home. She doesn't see it as a great investment. Her reasons: it's illiquid, hard to sell quickly. There's a lack of transparency often, lots of maintenance hassles, tenant issues, and frankly, she feels the returns are often uncertain compared to equities. She even said, I don't even enjoy it.
Fair enough. What was the other one?
Cryptocurrencies. Her reasoning there was straightforward. She doesn't fully understand the underlying tech, and they remain largely unregulated in India. So for her, it's a pass.
Practical reasons. Okay, but what about her own financial missteps? She's obviously very successful now, but did she share any stories about learning things the hard way?
Oh, she shared a fantastic story, really powerful and honestly relatable. Back in 2007, she was young, just off Wall Street, earning well. And she admits she rushed into investing without a proper plan. She basically dumped 100% of her bonuses straight into equity markets. Didn't think about needing cash for debt, didn't have a contingency fund.
Uh-oh. I can see where this is going. 2007.
Exactly.
Yeah.
Then came 2008, the global financial crisis. Markets crashed. And in 2009, she needed cash. 70 lakhs, she said, to help start a new business venture. Where was her money? Tied up in equities that were at rock bottom. She had no choice but to sell, to redeem at the absolute worst point in the cycle. She described it vividly. It's horrific, horrible. I still have nightmares about it.
Wow. Selling at the bottom. That's the investor's nightmare.
Totally. But the lessons were huge. First, the critical importance of planning. Second, diversification. Never let one asset class become a totally dominant part of your portfolio. Third, always have a contingency fund in safe, liquid assets. And another point she made, especially regarding unlisted or private investments, conviction in the business model matters way more than just getting a cheap price. Don't buy what she called Katra stock, basically junk just because it seems like a bargain. You have to deep dive into the heart of the business.
Those are incredibly valuable lessons, forged in a pretty tough experience. Okay, speaking of business and conviction, Shark Tank India. She's famous for being a shark. What did that whole intense TV experience teach her about investing?
That was fascinating too, because it seemed almost opposite to her data-heavy day job. First, she said it taught her the power of instinct. On the show, you have maybe 45 minutes, very little hard data, just some papers. You have to make quick calls. And she found that her investments, driven more by gut feel on the show, have actually done extraordinarily well.
Interesting. So instinct still plays a role.
Apparently so. Second, it reinforced playing in understood spaces, sticking to consumer businesses, financial services areas she knows deeply. Third, she got a front row seat to the explosion of new business categories in India. So many D2C brands, niche areas like pet care, things she hadn't really considered investable before. It also gave her a real appreciation for the value of unlisted investments, meeting entrepreneurs, understanding that whole startup world, and finally, just a huge respect for the discipline of the TV industry. Those 15-hour shooting days, the commitment involved, it's intense.
That's quite a range of takeaways, from gut instinct to TV production discipline. Okay, one last thing. What advice did she have for people like us, content creators, or really anyone sharing knowledge and information?
Her message was simple but important. Use the influence you have, especially on social media, responsibly. She urged creators to focus on reasonable, non-sensational content. Because, particularly in a place like India, she feels that doing education is a service. It's about providing real value, not just chasing clicks or going viral.
A great reminder. That responsibility matters. whether you have a huge platform or are just sharing ideas with friends.
Wow, okay. What a deep dive that was. We've covered so much ground. Challenging that whole new middle class idea, drawing that clear line between good debt and bad debt, exploring that unique Indian savings framework, getting smart tips on picking mutual funds, and even hearing about the power of instinct and learning from mistakes.
Yeah, and I think the core takeaway, echoing Rathika, is that finance doesn't need to be scary or overly complex. It really can be deep, fun, and approachable. And just having open, transparent conversations about money with yourself, with your partner, is incredibly valuable.
Absolutely. So here's a final thought for you listening. Given how much the world has changed the economy, social media pressures, everything, what's the one money conversation we'll start this week? Or the one financial habit you'll adjust to align better with your actual goals, not just what everyone else seems to be doing? Something to think about. Thanks for diving deep with us today.